It's showtime.
Hello everybody and welcome back to the channel. In this video where we're going to run over the top 4 US indices ETFs. We have selected today the following 4 for you. The first one is the DIA SPDR Dow Jones Industrial Average ETF Trust. This one is tracking the Dow Jones Index and it has gained year to date 6.15%, so nothing really special. Then we have the next one, which is the VOO, the Vanguard 500 Index Fund ETF, which seeks to track the S&P 500. It has done a bit better. It has gained 14.95% this year. Then you have the IWM, which is the iShares Russell 2000 ETF, and as the name implies, it seeks to track the Russell 2000 index, and that has done even better, 20.29% this year, so really good. However, we cannot go away from the one who has been performing the best by far, and that is the QQQ, the Invesco QQQ Trust Series 1. This one, the name does not imply what it seeks to track, but this is to track the Nasdaq Top 100, and again it has done superior this year, returning 45.87%, so really remarkable. So just to differentiate the 4 ETFs, the VOO follows the S&P 500, which covers the largest 500 US publicly traded companies. Then you have the Nasdaq Top 100 under QQQ, which covers the 100 largest and most actively traded US companies that is listed on the Nasdaq Stock Exchange. Then you have the DIA, the Dow Jones Index, which is tracking 30 large publicly owned blue chip companies that is traded on the New York Stock Exchange or the Nasdaq. And finally, the Russell 2000 IWM, which is following the 2000 smallest capped American companies that is part of the Russell 3000 index. When we are analyzing ETFs, we first want to understand how liquid they are, basically how easy they are to buy and sell. And one way to understand that is to look at the median bid-ask spread for the last 30 days, which is basically the difference between highest price buyer is willing to pay and the lowest price that the seller is willing to accept. So if you have a small percentage here like the VOO and 0.01%, it means that it's very liquid because the difference between buyer and seller is small. And as you can see across the board here, all of them are very liquid. Similar if you look at the average volume, which shows the amount of shares that is being traded on a regular basis. Again, there is several millions of shares that are being traded, so this is another indication of a very liquid ETF, so that is good. We can also look at the beta ratio, which just shows the ETF's volatility in relation to the overall market. And as we can see with the first 3 of them, they are around 1, which means that they are in general following the market, which is by no surprise considering that the indexes are covering the largest US publicly traded companies. The IWM is a bit more volatile. Again, no surprise as this one considers a lot more small cap stocks. We can also look at the tracking error, which shows the divergence between the price behavior of the ETF and the price behavior of the underlying index. And as we can see here, the tracking error of VOO is almost 0%. So again, it's more or less tracking the index. QQQ a bit higher with 7%, DIA with 5%, and IWM with 15%. So again, this is just an indication of that there can be a difference between the return on the ETF and how the actual index is moving because it is not perfect, with the exception of VOO, which is close to 0%. So when analyzing an ETF, we also want to understand the risk profile from a country perspective. And here we're not going to spend too much time because it's US indices. The majority of risk is obviously going to be in the United States. Next, we have the top 10 company holdings. It is much more interesting to take a look at to get an understanding of where your exposure is. And the VOO, no surprise here, it's the biggest companies in the US. So you have Apple, Microsoft, Amazon, Facebook, Alphabet, etc. quite diversified because you have 500 different companies in the portfolio. On the QQQ, it is very similar companies. You have Apple, Microsoft, Amazon. You also have Tesla here and a lot of other well-known companies that we have covered in separate videos. Again, your exposure is a little bit higher here because you have less companies part of the portfolio. It is only 100 companies approximately. Then you have the Dow Jones, the DIA. Again, here you can see it is very, very narrow in terms of diversification because you only have 30 companies that you are following. This is the United Health Group. You have the Home Depot. You have Salesforce.com that we covered in a separate video. You have McDonald's that we have also covered. You have Microsoft. So still very well-known companies under the DIA. And finally, you have IWM, where there's a lot of companies that we do not know. Darling Ingredient, Novavax, we have never heard about them, but we have Penn National Gaming that we have covered in one video. You have Brookfield Renewable Corporation, we covered that in a very recent video, very interesting company. You have Caesars Entertainment that we also covered in one of our first videos, and you have Marriott Vacations Worldwide Corporation, which I assume most people know. So still a few known companies there, lot more diversification you get under the IWM, and as you can see, the biggest position here on Darling Ingredients is 0.71%, while as under the DIA it is 7.46 for the United Health Group. So quite a difference when looking at these two ETFs. So just to quickly summarize what we have run over. In terms of the industry focus, it is large cap for the first three, and the last one is in general small cap companies. On the risk, it is more or less medium. It is not a lot less than the general market. It is not a lot higher than the general market, which is, again, as we mentioned, no surprise. On the liquidity, all of them are very high. It's easy to buy and sell. The country diversification in general is low for all the ETFs. They are focused primarily on the United States. However, keep in mind, of course, that these companies are global companies, so you somehow get global exposure anyway. Finally, you have in the stock diversification, VOO and IWM is high. Here you get between 500 to 2,000 different companies. On QQQ, you only get 100, and DIA, you actually only get 30. So it's close to being low actually on this one, but we have still put it as medium. For the investors who are much more dividend focused, it's obviously important to understand whether these ETFs are paying any dividends and how high is the dividend. And as you can see, the DIA is the one paying the highest dividend with 2.03%, followed by VO with 1.61%. IWM 1.13%, so nothing special, and QQQ has the lowest with 0.55%. The total expense ratio is another important aspect to look at for ETFs, because if you keep it for the long term, it may have a significant influence on your total return, because this is the cost that you're going to pay on an annual basis. And as we can see for VOO, it is very, very low cost, 0.03%, so almost nothing, while as for the others, you're paying between 0.16 to 0.24%. So it's not crazy high. It's probably somewhere in a little bit less than the medium range, but there's still a big difference between VOO and the rest. And again, if the returns are close to be the same, well, then in the long run, it may be better to stay with VOO than the others. We can also look at the uptrend of these companies, and how we do that is to look at the simple moving average for the 20, 50, and 200 days. And basically here we're just benchmarking the current price versus the average of the selected range of prices for those days. So this is basically a technical indicator. And as we can see, we are very happy. All of them are in an uptrend for all the different simple moving average. So that's a really good sign. Finally, you obviously can buy and trade ETFs very easily, similar to stocks, but a lot of people prefer to keep them for a long period. So we thought it would also be meaningful to have a look at the return for the last 10 years and see the differences. And as we can see here, The DIA is again very close to IWM, but one paying the lowest with 154.65% over the last 10 years. It's not a bad return, but compared to, for example, the VOO, it has paid 188.16% over the last 10 years. And you have the QQQ, which has paid 452.79% over the last 10 years, so completely outperforming the three other ETFs. What is quite interesting is to see that it was only for the first 2.5 years approximately that the return of all the ETFs were the same, and thereafter QQQ broke out and simply since has outperformed all the other ETFs by far margin. You can see just over the last year they had a return for the last 9 years in 250%, and now over the 10 years it is 452%. So they have completely destroyed the other ETFs from a return perspective. Back to the summary overview, we first looked at the dividend yield, and for DIA was paying the best, followed by VOO and IWM. QQQ was very small with 0.55%. On the total expense ratio, another important metric, VOO was by far the cheapest one with 0.03, while as the three others was between 0.16 to 0.24, so not crazy high, but still not cheap. Then we looked at the performance for 1 year. QQQ in the beginning of the video completely outcompeted the other ETFs, and similar for the last 10 years, QQQ has outperformed the other ETFs. VOO the second one, followed by IWM, and DIA is the one who had performed the worst. Finally, we looked at the trend of all these ETFs, and they are all in an uptrend as of today. So what is our final conclusion on these ETFs? Well, we believe that it would be good to take a bit from the different ones, and by that not only going all in into one ETF. If we look at the VOO, long-term good value, and you get great diversification. The QQQ, it has performed the best, and here you really take advantages of what we consider mode companies, basically companies with a competitive advantage that we expect will perform well in the coming years. The only reason why we are not saying to necessarily go 100% into only one ETF is simply because some of the companies where you have a big exposure under the QQQ are being scrutinized by governments around the world. They are being fined for abusing their competitive positions. There's rumor that they want to break some of them up, and we do acknowledge that some theory says that that is good from shareholder value, but there's also a lot of cases where it's proven that these secret values doesn't appear afterwards. So we don't think that it's necessarily only going to be good for these companies, and these kind of situation may impact the share price for those companies, and as you're heavily exposed to them, well, that will be reflected obviously in the return. So that is the only reason why we don't really say go only for this one. Then we have the DIA. Not all the companies has the wow factor, and it has underperformed consistently for years, so we are actually not really that hooked on this ETF. And we think that with a lot of the companies that are within the DIA, you will also get the exposure in either the VOO or QQQ. Finally, it's always good to do some diversification, and for the IWM you always get a lot of good exposure to smaller companies that you don't get in others. And this ETF has performed well in the recent year, and again, it may do so in the future. We definitely believe that there's a lot of innovation happening within the smaller companies, and this is why we think that this ETF may be a good buy as well to have in your portfolio for the long term. This was all we had for today. We really hope you enjoyed this video. Please subscribe for future content. Please give us a like, it really helps with the algorithm. Please provide a comment in the comment section. There may be points that we have missed, and we always like to hear your feedback. Otherwise, there's not much more to say than have a great day, stay safe, and see you next time. Hasta la vista, baby.